Good afternoon, everyone. Welcome. Thank you for joining us. My name is Veronica Birch Flores. I have the extreme honor and privilege of serving as the Chief Operating Officer at First National Bank of South Miami. I also have the privilege of sitting on our board of directors. And this month, I celebrate 21 years here at First National and 41 years as a community banker. And I can tell you from my experience, there is no better community bank than the one you're with today. So welcome, because I am sure you're going to find today's program filled with all kinds of really interesting information. Amit is brilliant, and he has been coming down for the last several years, and we are always pleased to have him speak with our private client. And it's usually a standing room only, but of course, COVID has put the kibosh on our in-person cocktail reception to welcome Amit. So today we're doing it via Zoom. Nevertheless, without the refreshments, I'm sure you're going to find what Amit brings to you really refreshing and enlightening. So we're going to get to that. Who are we? Well, we are one of the remaining few community banks that is privately owned. We have been held in the same ownership structure since 1952, and on this very same corner of 57th Court and Sunset since then. So we have a lot to be proud of. We have been able to curate some of the finest bankers in all of South Florida. We've become an employer of choice. So if you wonder how are there so many great bankers at First National in one place, it's because of who we are. So we welcome you and we thank you for your loyalty and your patronage to our fine institution. We are very well capitalized, both on the bank and the holding company levels. The Wirtz family, our main shareholders, have an awful lot of money in our bank, and they demonstrate their confidence in our bank to us in many different ways. We've earned the prestigious recommended status by Bauer. Bauer is the leading bank rating agency. They're actually located here in Coral Gables, but they are often looked to all over the country for rating banks and safety and soundness. And we are in the company of only 5 other banks in the entire state that we have been recommended every consecutive quarter since 1989 for our safety and soundness. So not only are we friendly folk that know what we're doing with our expertise, but we're pretty good at it by demonstrating our safety and soundness and our commitment to preserving equity for all of us. So we are committed to you, to our clients in our community. We demonstrate that in a variety of ways. Other holdings, we're so proud to be part of the Wirtz family holdings. Other Wirtz family companies are the Wirtz Corp and Wirtz Realty in Chicago. Of course, the beautiful and fun Chicago Blackhawks, another industry sorely hit by COVID, the insurance agency, and then Breakthrough Beverage. So we are part of a larger family, and with 3,000 employees and $2 billion in annual revenue. So we appreciate your time and your attention today. And I am super looking forward to what Amit has to bring. Before I hand it over to my colleague, I do want to go over a couple of housekeeping items. In Zoom, of course, by now you know there is a chat feature. If you have any technical issues or you need to say something directly to one of the panelists, then you can always put that in chat. And then, of course, there's Q&A. At the end of today's program, Amit is going to kindly respond to any of your questions that you might have. So if during the program you have a question you want to pose, then please feel free to put that up there in the Q&A section, and we'll get to that at the end of the program. Without any further ado, because I can't wait to see what Amit brings to us, I want to introduce you a very wonderful man. I'm proud to call him my friend. He is an outstanding banker by any measure and enjoys a stellar reputation in our community. We're thrilled to have him as part of our family, our Director of Private Client Services, Executive Vice President, Angel Medina.
Thank you, Veronica, and thanks to all of you for attending today's event. It's really a pleasure to work with an amazing group of professionals whose mission it is to help you and your family with your wealth and well-being. However you define wealth, it's important that you have a clear path towards achieving your financial goals. You wouldn't take a road trip without a roadmap. At First National Bank of South Miami, our teams work collaboratively through a private banker who's the quarterback of the relationship to help you manage, preserve, and build your wealth. They'll take the time to ask thoughtful questions and stay in close contact with you through life's ever changing events, especially those that can impact your financial future. At First National Bank of South Miami, we're a family company committed to our clients for over 67 years. We pride ourselves in taking the time necessary to understand your individual needs, wants, and wishes. Our team is driven by helping you achieve your goals. Our decisions are local, which means that we can be responsive and flexible. Today's event is just one more example of how we deliver value-added services to our clients. Well, whether you're already a client of First National Bank of South Miami or one day would like to be, we welcome you to today's informative and timely event and invite you to call on me or any of our private bankers to learn more about our personal approach to help you achieve your financial objectives. An important tool in achieving your goals is through financial planning. And here to talk for a second about financial planning is Gus Martello, our certified financial planner.
Thanks so much, Angel, and it's great to be here today. And thank you for everyone that's taken the time to join us on our 2021 Economic Outlook webinar. So like Angel had mentioned, an important tool in achieving your goals is through financial planning. I'd like to describe financial planning, simply put, as a collaborative process that maximizes your chances of reaching life goals. It's about aligning your hard-earned money with what's most important to you. Financial planning is super important because it gives you the opportunity to know where you stand in reaching your needs, wants, and wishes. Here at FNBSM, we can actually take a peek into the future and see how on track you are to reaching and protecting your basic living needs, such as housing, healthcare, food costs, and insurance. Once the essentials are covered, we can then check the likelihood of funding your wants. Let's say remodeling your home, which many people are doing these days, or traveling once things get a little more back to normal. And finally, if your needs and wants are funded, we can help you plan for those wishes. Sending all the grandkids to college, maybe you want to leave a legacy for your family. Our team is ready and here to partner with you to help you achieve your planning goals. With that said, I'd like to introduce our Chief Trust Officer, Barry Givner.
Well, thank you, Gus. Great opportunity to speak before everybody here. Just to tell you a little bit about our Trust and Wealth Management Department. We're one of the few community banks who has a Trust and Wealth Management Department. It's quite a rarity. We're a corporate fiduciary. As a corporate fiduciary, we have your interest in mind. And that is something we've always had. I think you've been hearing a lot of real brokers, stockbrokers talking about that they're a fiduciary. Well, we've been one since the late 1950s. We offer a full array of trustee and wealth management services, such as investment management portfolio services, IRA rollover services, irrevocable trust services, estate settlement services, to name a few. One of the other benefits of having us to work with you and your family is that we're local and we're responsive to your needs. We have local decisions are made. We don't have to go to we don't even have to go to Chicago to make decisions with regards to how trusts are managed or administered. We also provide customized investment management portfolios that could be tax sensitive. If you come to us with an existing portfolio, working hand in hand with Right Investor Services, we're able to work with you on that portfolio and migrate it to their style of management, which I think you'll learn a lot about today. And one other thing before I introduce Amit, trust and estate planning checkups. That's something that we do for our clients, no cost. We take a look at what you have and make some recommendations. We don't do drafting. We do have an attorney on staff, but we can't practice law in that respect. But we'll work with you and your professionals to come up with a plan that makes sense for you and your family. That being said, I'd like to move on and introduce our speaker for this evening. For over 60 years, Wright Investors Service has been providing investment management services to fiduciaries. Wright was a pioneer in exercising a disciplined approach to selection of investments. Wright was the creator of WorldScope, the world's largest database of fundamental corporate data. And by using WorldScope, Wright filters the universe of equities through 32 proprietary qualitative and quantitative screens to develop their portfolio strategies. These 32 screens are driven by factors such as growth, profitability, sustainability, financial strength, and investment acceptance. From these quantitative filters, the results are reviewed consistently by a team of experts led by Amit to create long-term sustainable portfolios. First National Bank has been utilizing the Wright approach for several years now, and we are very pleased with our partnership. More importantly, our clients are very pleased with their advice and results. Wright is led by Amit Khandwala, the company's chairman, CEO, and CIO. Amit holds a master's degree from the University of Harvard, and he has over 30 years investment experience and has been recognized nationally for his proprietary strategies, which have delivered superior results. It was great pleasure that I introduced to you Wright Investors Services CEO, Amit Khandwala. Amit?
So good afternoon, everybody, and thank you very much for joining us today. Before I begin, special thanks to Veronica and all the hardworking folks at First National Bank of South Miami who helped make this event possible. Today, I hope to cover 10 key issues from the economy and interest rates to Biden's tax policy and the relevant market outlook. I hope that each one of you will find something of value from this presentation. So 2020 has been a year for technology. So what this chart shows on the left side is that technology-driven NASDAQ is the best performing index at 28.1%. What is quite surprising, though, if you go a little bit further down, is that the bond market has been doing very well. And everybody expects the bond market to sell off, but unfortunately what happened with the pandemic is the Federal Reserve had to bring the rates down almost close to zero, which as a result brought the prices of the bond up. On the rightmost side, you will see the oil prices. Oil has been very, very volatile, and it has been weak. So from a consumer standpoint, that has been an added benefit. But really what has happened is that the supply today is far greater than the demand. Value stocks, you may read something in the media about value stocks, but this chart shows that since 2001, value stocks are running close to 20-year lows. So this style has been totally out of favor. This style basically means is you buy cheap stocks based on their valuation and hold them for a long term. But that strategy has not worked. And this, in fact, has caused some of the hedge funds as well as money management firms to close shop because they were very focused on just value stocks. We, on the other hand, work with the bank in providing a diversified portfolio of securities, which is why the performance that we deliver for our clients is quite robust. Actually, today, one can say, based on this chart, that there is now value in value stocks. S&P 500, many of you may have seen that the S&P has been up strong this year, especially after the stimulus, but very often the numbers are not very reflective of the broad market. So what this chart shows is these are the top 10 companies within the S&P 500 based on their market cap. And if you look at their returns are about 7.1%. This is through October 31st. But if you look at the remaining 490 stocks, they're actually down 4.4%. So the rally in the S&P has been very, very concentrated in names like Apple, Microsoft, Facebook, etc. In fact, the impact of the tech sector has been so huge that if you look at this chart, it shows that the S&P 500 up until October 31st in price-only terms is up 1.4%. But if you deducted or reduced technology stocks from that, the index actually is negative 4.3%. So when you look at your portfolio and you see negative returns for October 31st and the S&P being up, recognize that the S&P is only driven by 10 stocks. In fact, when you look at the performance of US versus non-US, what this chart shows is that the dark blue line is the performance of the top 10 names in the S&P, and at the bottom, the light blue line is the performance of the international markets. And the little darker blue on top of that is actually the performance of the 419 names within the S&P. So really, when you take out the impact of the top 10 names, the S&P has performed just as well, maybe slightly better than the non-US markets. So let's turn to the economy. Clearly, the COVID has caused a recession in most of the major markets, except, guess what? China, where the virus emanated from. The US had a significant decline in the second quarter, falling almost 31.4%. It's not very surprising, simply because we had a pretty much of a shutdown in the economy. But then, with the economy opening up and the massive stimulus, the economy quickly bounced back, rising 33.1% in the third quarter of 2020. Obviously, this was a big bounce, and we expect that going forward, as the economy slowly opens up, the US economic growth will once again start picking up. On the global front, what this chart shows, you can see on the top is a chart of the world. Everything is red, and red really means it's in recession. The only part that's blue is China, which you can see and as I shared before, is clearly experiencing a higher growth than the rest of the world. On the bottom panel, what you see is 2020 projection by the IMF for global growth to decline 4.4%. Now, 4.4% growth is a pretty significant decline, but if you saw this chart maybe 3 months ago, that number was 4.9%. So clearly we are headed in the right direction, but still it's a recession up until 2020 for sure. So what is the forecast for the US economy? Well, the US economy is expected to decline about 3.6%. And we kind of monitor this quite closely because the growth of the economy cannot be out of sync with the earnings projections for US corporations. So, if you expect a recession, it's unlikely that US companies are going to have very strong earnings. So growth in an economy is an important number to look at. This number, by the way, was about 4% back in June, now meaning negative 4%, now it's negative 3.6%. Surprisingly, you'll see that the inflation number in 2020 will remain at 1.2. So, at the time when the economy was shut down or locked down, you saw there was runoff in paper products, there was a runoff in the food in the grocery stores. None of that has caused a level of inflation to rise significantly. So inflation remains to be quite benign. So how is the US consumer? Prior to the pandemic, on the left-hand side, the chart shows the blue line, and that is the US household debt, including the mortgage debt, as a percentage of GDP. And you can see that the line has steadily been declining since the Great Recession. And the US consumer has slowly been delevering his balance sheet, reducing the amount of debt they had, less loans, etc. And then all of a sudden, you can see a blip up going up to 83%. Now, that 83% is not caused by the US consumer increasing the debt, but more caused by the decline, the significant decline that we saw in GDP. So once the GDP number gets settled down, we will see this number will once again show a declining trend. On the right side, though, the most important part about this pandemic-related activity has been a significant ramp up in the US savings rate. So on the bottom of the right chart, you will see savings, and the savings rate blipped up to about 15.8%. Now that is a significant number. If you are a consumer and you have a job, you're not going to work, so you're not commuting, you're not eating in a restaurant, etc. So those costs goes down. If you're a corporation, you don't have a lot of travel and entertainment expense. You don't have expenses for lunches, advertising, etc. So that expense, even at the corporate level, has gone down. So the savings rate obviously has been a great protector of the US consumer during this pandemic. So housing, clearly housing has been on the tear with people, I know you guys are in Florida, you probably have seen significant amount of new residents coming into your area. We are in Connecticut and we are seeing increasing flows from New York area coming into the suburbs of Connecticut. So two things have happened. There has been an increasing demand for new homes and existing homes. And at the same time, there's been limited supply. So the house prices have been going up. In this case, this is a mortgage delinquency rise. So you can see that the blue line shows that the number of delinquencies have suddenly taken a spike up. Now, one thing to be careful about when you read about this in the media is that this increase is not necessarily because people are declaring bankruptcies, but it is because sometimes many of the mortgage companies during the lockdown have deferred the payment of the mortgages for a few months. So eventually this number will go down, but it is not a function of increasing mortgage bankruptcies, if you will. Turning to retail sales, one of the things I learned early on in my life as a manager of investments is you never ever bet against the US consumer. So in this particular chart, you will see that the value of retail sales in the United States had a massive decline somewhere around March, April, May, because of obviously the lockdown. But soon after that, the pent-up demand increased the retail sales so strong that it is running over the actual natural trend rate that we are seeing on the retail sales. So you can see that little yellow dotted bar line, if you will, and you can see the significant spike up in the US retail sales. So the US consumer continues to be alive and kicking. Interestingly, with the lockdown, the bankruptcies have actually been declining. So if you look at the white line, you will see that the US bankruptcies have been easing down. And that is because the US economy was really quite strong prior to the pandemic. So the pandemic was an exogenous event. Nobody knew, nobody planned, but it did not change the actual structure of the US economy in terms of the US strength. And of course, the US stimulus, as well as the monetary stimulus, was extremely timely and quite beneficial. In fact, what this chart shows on the right side is the loan loss provisions. Now, Veronica would be an expert on this, but what this chart shows is just during the first, second quarter of 2020, the top 4 or 5 banks in the US ramped up the amount of provisions that they were taking in the event that they would have significant loan losses that they would experience. But then quickly in the third quarter, which you can see the bar go all the way down, significant decline, almost at the run rate that you see prior to the pandemic. So the US banks now are very comfortable with the loan losses, and therefore the provisions have gone down quite significantly. Now, that is a very good sign, because generally, if you are in a recession, which we are, the banks will pull back on the loans, will pull back on the spending until the economy recovers and the Federal Reserve is trying to goose up the economy. But in this particular case, the banks know that the economy is relatively strong, that it's a pandemic that is driving this exogenous event, and therefore the loan provisions have been reduced substantially. Turning to employment, U.S. economy, as I said, had a significant pullback in the second quarter, and as a result of that, there was an increase in unemployment, which is it's not a surprise. What is surprising, though, is that if you looked at this number back around about a couple of months ago, we had peak unemployment at about 22 million. Today, that number has gone down by half at about 11.1 million. Still a big number, but a drastic improvement from 22 million, in our opinion. One outcome of this economic recession is that many businesses have shut down for good. Take the case of restaurants. I don't know how the situation in Miami is, but clearly in Connecticut, many of the small restaurants have closed down because they just didn't have the staying power to pay the rent when there was no customers coming in. Unlike Miami, where you have great weather all year round pretty much, in Connecticut, we are beginning to see colder weather come in, which means the people are not going to be sitting out and eating food anymore, which could lead to further businesses closing down even in Connecticut. So one outcome of this was some companies just went out altogether. And so what this chart shows, the white bars are the temporary layoffs. So the temporary layoffs are obviously coming down as the economy is slowing up. But if you see the blue bars, you can see that uptick, and that uptick is permanent job losses. And that number, we think, is going to get worse. Number one, if the economy doesn't fully open up and we get set into the winter months. So where do we stand with the labor market today? We look at two numbers. One is the unemployment rate, and two, and very importantly, the underemployment rate. So the unemployment rate stands at about 6.9%. And so you may ask, why bother about the underemployment? So before I talk about the underemployment, 6.9% unemployment compares to 3.5 rate that we had in February, which was prior to the pandemic. So clearly the US was seeing very, very historic lows in the unemployment rate. But with the pandemic, the number increased and it's come down, but it's still much higher than where we were in February. So turning attention to the underemployment, the underemployment situation was a very bad situation if you look back in 2008 during the Great Recession, because many of the people who are employed, they said two things. One, let me work part-time because I can't get a full-time job. Number two, I'm too old, I'm not going to get another job, I'm just going to take early retirement. So it took a significant amount of people out of the employment market. So the unemployment rate, when you look at the U6, includes those people who are working part-time and those people who are underemployed. And so that number actually was quite low before, but now it stands at about 12.1. It was only about 7% back in February. So we are not out of the woods yet on the labor front. And therefore, when we talk about the stimulus, it is important to recognize that until the employment number gets lower, the need for stimulus will still continue. One surprising thing about the pandemic is during the pandemic, you can see that there was a record increase in the number of business applications. That is a good sign that the economy underneath is kind of strong. And so when they see an opportunity, businesses are beginning to set up. So that is a positive sign at the economic front. And you don't hear too much about that, but I want to share that with you as well. So on the interest rate front, on page 23, this has been the least loved bull market. We've had an increasing trend in the equity market since 2008, but you can see the black line, and the black line shows the amount of money that has flowed into bond funds and bond ETFs. It's a record, you can see that. And at the same time, the red line shows the decline in the amount of money that has gone into equity equity mutual funds and equity ETFs. So clearly, more money has gone into fixed income than it has gone into equities. So where do we stand on the 10-year or our interest rates? The 10-year yield is roughly around 87 basis points as of close today. We are at more than 40-year lows on the 10-year treasury yields. Mathematically, there is only one. It's not too far from zero, but it's quite far away from the highs of 12 and 14%. So eventually, we expect the interest rates will rise. Whether they're going to be today or tomorrow is anybody's guess, because Federal Reserve is standing to tap down the level of interest rates until the employment situation gets better. So I think this is a very, very important chart, whether you're an investor in fixed income, in mutual funds, or whether you are investing in single security bonds as well. Because we expect interest rates to rise, you need to understand that when interest rates rise, the price of bond falls. When rates rise, bonds fall. Many people assume that when the bond yield goes up, they will be getting a better coupon and they will make money. But what they don't recognize is that the price of the bond falls, and therefore you could actually lose money in a bond. So here's an example that shows that if the interest rates, you can see my cursor, you're at 50 basis points, or if interest rates were to rise by 0.5%, and if you had a 10-year bond, you could have a total loss of 2.1% on your bond over the 12-month period. Now, one of the reasons to also emphasize this is today, if you are investing in bonds, the bond market is the most overvalued that we've seen in its entire history. So when you try to buy a bond, it's very rare that you buy a bond at 100 or at par, which means you're paying more to buy the same bond 5 years ago. What does this mean? When interest rates rise, this 2.1% loss you see in a 10-year bond, the bond you buy more over $100, the loss is even more. So if you are a bond investor, either you hold to maturity or you be careful when the interest rates rise, because when they rise, your bonds will probably go down in value. Okay, turning to the oil front, oil is trading around $41. I'm sure you've seen in the newspaper, OPEC is trying to cut back on production so that the oil prices remains low. The reason I share this chart is that the US economy today, compared to the 70s and the 80s, is a lot less reliant on oil. It's not as intensive. And one of the reasons for that is not because we're not traveling more, it's because manufacturing is now more outside of the US. So US is more a service economy than a manufacturing economy. So you can see the impact of petroleum-based products to the percentage of GDP has been a constant decline. So even if the oil prices do have a rise, it is unlikely to have a significant impact on GDP, at least on the initial basis. As I mentioned today, even outside of manufacturing, 40% of our oil demand in the United States comes from driving cars and trucks. Now, as you all know, there is a big emphasis on having electric cars. And some of you may have read that by 2023, California is going to ban fossil fuel driven vehicles altogether. So the demand for electric cars is going to rise. But more importantly, the demand for oil for traveling with cars is going to decline. In fact, today, there are 3 or 4 companies actively involved in manufacturing electric trucks. And so, you can imagine that the truck traffic will now be electric driven, which will further reduce the demand for gasoline. So clearly, this number is likely to decline. And now with Biden, it's unlikely that the emphasis on electric cars is going to be reduced. One major user of oil is also airlines. And as you can see in this chart, that the US airline traffic after the lockdown declined almost close to 100%. But slowly that number has begun to get better, but we are still around about 60% below the normal trend line on what the US airline traffic is going to be. And now with many companies demanding that their workers work from home, many in the technology space are permanently having people work from home. We believe that the US airline traffic is going to take a long time for them to come back to the normal. And therefore, there will be further reduced demand for oil and gasoline. One other important point to point out is because of the lack of demand, the US oil production, which is the white line, is still quite high, and you've seen that there's a cutback of production. That production cut, by the way, is by some of the shale guys going out of business, but also you can see that the crude production on the blue line, the inventory has gone down, but the production, which is the blue line, has had a significant decline. Now, what does this mean going forward? Clearly, from a perspective of the production, it's very difficult to ramp up production unless you're OPEC. But we think that the OPEC, barring out the OPEC production, the shale production growth that we saw in the US is unlikely to ramp up fast because, as I mentioned, many of the shale producers have gone belly up and their access, because of their financial conditions, to the capital markets is low. So what does this mean for us, for you and me? It means that if the inventory level continues to decline and the production does not follow, that we are going to have an imbalance between demand and supply. And when the economy does open up, we may see the gasoline prices go higher. So that's something to be worried about going to the future. So on the COVID front, you guys read a lot about the COVID, so I just want to give you a few pertinent facts. The global virus-related death now have topped 1.2 million, but that's not all the bad news. If you look at the daily global cases on the left side, you can see that we had some peakiness initially, but the rate of increase is declining. The rate of increase is declining. But the most important thing here is that the virus-related deaths is going down. Don't get me wrong, not a single death is acceptable, but the point here is that even though the number of cases are increasing, the growth rate in cases have declined and the death rate has declined as well. On the vaccine front, this is something that is very, very unique and a result of the technology that is now available to the US and outside of the US as well. You may have heard of companies like CRISPR that have allowed, DNA splicing and dicing, and that has allowed the development of drugs a lot more faster than it could have ever been possible. As we speak, this is evolving. This is dated through end of October. There were 11 in phase 3, 6 have received limited approval. And since this chart, both Pfizer as well as Moderna have had wonderful results in terms of effectiveness of the vaccine. Now, Pfizer's drug is about 90% or so effective. Moderna's drug is about 94.5% effective. Now, I was talking to my wife and she says, well, the test is only 87% effective. And so got me thinking, what does it mean for a vaccine to be 90% effective? And what this chart shows, interestingly, is that, many people in the US take the flu vaccine as a course during the winter months. And you can see that the effectiveness of a flu vaccine is only 44%. I did not know that when I compiled this chart, but again, it's only 44%. In fact, if you have shingles, that effectiveness is less than 70%. So clearly, what this means, 94% is a fantastic effectiveness of the vaccine. But the sad part is today there are 6 billion doses that are going to be required. Now, in order for the doses to be manufactured on a mass scale, you need factories and facilities that can manufacture those vaccines. And there are only 6 vaccines in the manufacturing facilities in the world that can produce vaccines on a mass scale. So 6 billion doses and only 6 manufacturing sites. So you don't have to be a genius to know that we are not going to be able to vaccinate people within 12 months that easily. So we have a long ways to go, and therefore we will need to continue to maintain social distancing as well as wearing some masks. So let's turn our attention to the stimulus and deficit. Now, the fiscal response across the world, not just in the US, has been just fantastic. And the responses have been in 2 ways. One is where the fiscal measures were either revenue and expenditure measures, or 2, they were loan guarantees and equity injections. So if you look on the leftmost side, you will see the German market. In the German market, their fiscal measures, which was the highest amongst the developed world, almost 40% of their GDP, majority of that fiscal measures concentrated on loan guarantees and equity injections. Now, if you go all the way to the right, you will see the markets like US, Australia, Canada, and China. The light blue bars are bigger, which means that they have spent more money in getting money into the consumers. And in our opinion, that has been the best way to kind of provide stimulus within the market. The idea is you provide money to the consumers go in and spend in the market, and they provide a natural transition and flow of the money around the economy. That is the most efficient way, in our opinion, and therefore US has been in the forefront. In fact, if you look at the US, they have spent significant, just like Australia, in providing money to the consumers at the end. So the US really needs to be congratulated for a job extremely well done. Obviously, this has not come for free. This shows that the federal debt is on a totally unsustainable path. You can see at the pandemic level, we are running close to 100% of our GDP. If we continue on this path, we will be running 195% in 2050 in terms of federal debt over GDP. If you look at the next chart, this shows that today the US budget deficit by 2020 in terms of the fiscal budget will be close to 100%. And at last click in June, it was running about $2.9 trillion. The CBOE projects that this year's deficit is going to be about $3.7 trillion. So really, what does these numbers mean? To me, 3 billion, 3.7 billion, these are just rounding numbers at the end of the day. But there is a structural mismatch between spending and revenue. So the theory generally is that you spend today and hopefully it will create enough revenue, which is through taxation. So you spend money today, you stoke up the economy generates more revenue translates into payroll tax, corporate tax, and that allows the spending and the revenue lines to at least get closer or to revert. Well, you can see today that based on the projections unless the tax revenue, etc., goes higher, or alternatively, the GDP growth grows significantly, we are unlikely to get those two lines in sync. If that doesn't occur, here is what the estimates are. The income loss for a 4% family on average in 2028 is going to be $4,000 loss of income per family of four. In 2038, it's going to be about 8,000, and by 2048, it's going to be a staggering $16,000 per family. So clearly, this is totally unsustainable, and so we really need some action in terms of trying to balance the budget. Turning to the market outlook, I think it's important to point out with the new administration, what does this mean for the economy? What does this mean for corporations and also for individuals and lastly for investments? So the current Biden's proposal is for $7 trillion of new spending. Of the 7 trillion, 4 trillion is going to come from new tax increases, and the remaining 3 trillion are yet to be accounted for. So if you look at the sheer numbers, the Biden's tax increase is far larger than any time since 1968. And if you look at where the spending is going to be, it's going to be on healthcare and it's going to be on infrastructure projects. So those are the two main areas where there is going to be a focus of the spending. Okay, let's look at the tax rates and the tax revenues. So the Biden proposed tax rates impacts corporate tax, income tax, i.e. payroll tax, also small business tax, capital gains, and lastly, probably more relevant for Florida with the estate carryover tax. So corporate tax is forecasted to go up from 21% to 28%. I don't have to remind you that most of the taxes in the United States are not paid by the larger corporations, they're paid by the smaller corporations. Number two, income and payroll tax will go up from 37% to 46% almost. Small business tax, which is not really broadcasted that loudly, is going to forecast it to grow from 29.6 to almost double at 52%. Capital gain tax is going from 23.8% to 43.4%. And lastly, estate carryover tax is about 43.4. So I've taken each of these to try to explain to you what it means from your perspective. Okay, before we do that, it's important to just kind of circle on where are the major sources of federal government's tax revenue. So there are two main sources. The first one is individual tax at 50%, and the second one is the payroll tax, and that's at 36%. US corporation tax is only about 7%, and so that's not a significant contributor to the tax revenue, but the main components of the tax revenue are the individual and the payroll tax. Okay, as many of you know, the US federal tax system is progressive, which means the more money you make, the higher your taxes are. So what this chart shows is that the top 1% pays the effective tax rate of about 29% versus the lowest quintile of taxpayers pays only about 3%. So clearly, you know, the more money you make, the more taxes that you pay, which raises the issue on the fairness of a tax system. You know, I sound like maybe a capitalist, but really that I'm just trying to give you the numbers the way they are. Today, the high income households, they earn a disproportionate amount of pre-tax income. But when you look at the taxes that they pay, the taxes are even larger than the amount of the pre-tax income in proportion to the federal taxes that they pay. So, you know, it is progressive, and the higher, the richer you are, the more taxes you pay, and the more impact it has to your bottom line. In terms of the corporate tax, the impact on the S&P is likely to reduce the taxes by profits by about 10%. So you can see here that the EPS consensus estimate is about $165 before the taxes. If the Biden tax was to be instigated, the corporate taxes would decline. I mean, the corporate profits would decline to about 148. But if the China tax were removed, the impact of the tax increase would be a little bit less, and the taxes would not, I mean, the profits would only go up to $157 instead of 165. Okay, tax cuts. Now, as you know, that when we had higher taxes, there was an inversion. So what that means is companies were actually creating offshore entities, and they were establishing corporate accounts over there and not bringing the money back. When the Tax and the Jobs Act ended, the corporate inversions, what it meant was companies were coming back into the US, cash was getting repatriated. So it's not going to be a surprise that if the corporate taxes were to increase tomorrow, we would once again see that money would stop coming back into the US. Companies would keep the monies overseas. Capital gains. Unfortunately, capital gains tax has not been over 30% since 1978. Two impacts. On the S&P on the top panel, you can see that S&P, when the capital gain tax goes down, S&P goes higher. Unfortunately, on the right panel, you'll see, again, I don't want to go into details, but generally, when capital gain taxes goes higher, small caps underperform the large caps. So something important to keep in mind when you do your asset allocation. In terms of the dividends, because they are going to be taxed now at 59% instead of 40%, it's not a surprise that companies may begin to pay less out in dividends. However, in terms of the S&P, as I mentioned before, most of the S&P profits are kept outside of the US, so they tend to pay less taxes. There is very little relationship between the corporate tax rate in the US and the S&P 500. But that is not to say that the small companies and the mid-cap companies are not going to have a negative impact. Now, one good thing, if you will, in this election is we have a good chance that the Congress is going to be divided. And we have only had 2 times in the past where we've had a House, which was, the House was Democrat, the elected president was a Democrat, but the Republican controlled the Senate. This has been the first time since Grover Cleveland was elected president in 1884. What does that mean for you and me? We're likely to see more gridlocks, and hopefully the tax policy will be a lot more muted than what has been initially put forth by the Biden administration. On the stock market front, the cash balance, because of the savings, has increased by $600 billion since end of 2019, significant amount of cash on corporate balance sheets. If you look at the earnings beat today, 86% of the companies are beating their estimates, which is a highest number that we've seen in a while. On an average, it's a 65% beat. So earnings surprises are running 20% higher. That means that the corporations in the United States remain strong. Earnings curve, again, with the economy opening up, has eventually now showing a little bit of a positive trend, which is again a very good sign. Consensus estimates again are beginning to trend higher. Again, they had fallen way lower below the dotted line, and so that is a good sign again. Valuation wise, if you look at the equities, which is the top panel, versus the corporate bonds, anything over the average line is a positive number, and that is showing that the US equities are much better value than fixed income. And if you look at the bottom relative to the 10-year treasury, we are fantastically cheaper on the equities than we have been on fixed income today. One very important point is there's a lot of money on the sidelines still. You can see that the assets in money market funds are still about 700 billion, greater than the pre-pandemic period, a little bit less since May, but still quite high. And so the rally in the stock market can still be sustained if this money were to go back into the equity markets. So in sum, we believe that obviously the negative growth in the US and rest of the world will be with us for 2020, but we're seeing signs of growth coming in 2021. Inflation remains benign. We are not going to see runaway inflation, and therefore the need to raise interest rates, whether it be in US or non-US markets, is extremely low. We believe that the job market will once again see a little spike up in unemployment. There's a couple of things driving it. One is winter months will create some more unemployment, and number two, the enhanced benefits on employment front are coming to an end. And as the savings rate gets drawn down, and as some of the losses on the job market become permanent, the stimulus will absolutely be necessary to help the economy. A divided Congress is going to cause gridlocks. This is actually going to be a very good sign for the pharmaceutical companies. Equities remain in a bullish trend. And lastly, in an environment where there is such a high level of volatility, fundamentals of companies should and will remain an important consideration. A lot of information. I hope you got something out of it. I will turn it back to Veronica for questions and answers. Thank you for your time.
Thank you so much, Amit. That was wonderful and enlightening. We do have a few questions, one that was posted in the Q&A, and I got a few emailed to me as well. So our first question is, do you know why we are hearing that Warren Buffett has been selling off his positions in Apple?
I think Apple has gone up significantly. It could just be a little bit of profit taking, if you will. The biggest move that we've seen in Buffett land has been in shaving down and selling out of banks, because obviously if interest rates remain low for a long time, there is going to be compression in the margins in terms of net interest margin for banks. And so you can see that move there. But they are also been getting into pharmaceuticals, and that is precisely, it just came out this morning that Warren Buffett has been buying AbbVie and AstraZeneca and pharmaceutical companies. And therefore, I think they are not, number one, better values because they have been beaten down because expectations were pharmaceutical companies are going to be beaten down by the government. But now with the divided Congress and a gridlock, obviously that's a good environment for the pharmaceuticals. So number one, Apple has done fantastic. It's has done very, very well. So it could just be some profit taking to reduce some exposure there. Sell off the banks and moving into pharmaceutical is more of a strategy than reducing Apple.
Great. So one of our guests has a comment beckoning some sort of explanation. Is it odd for increasing gold prices with an increasing stock market?
Yeah, I think gold prices have been kind of more the flight to quality. At Wright, we did a research on the efficacy of using gold as an inflation hedge, and we found it to be a very poor indicator. So very often what you find is people get nervous and go into gold. The first point where people started getting into gold is saying, all the governments are spending tons of money, there's going to cause runaway inflation, and therefore gold should be bought because all the currencies are going to get devalued. We didn't have that. We didn't have inflation, and gold is finally giving up some of the momentum that it had. In fact, what we found, and when you think about it logically, it makes a lot of sense, is that the best hedge to inflation is actually the equity market. And when you think about it this way. If there is inflation, that means there's pricing power for companies to move their products until the Federal Reserve steps in and beats down the companies by raising interest rates. And then obviously the economy goes into recession. But up until then, as inflation is rising and companies are pushing the price increases to the consumer, they are printing money, and therefore equities tend to be the best inflation hedge. Gold, on the other hand, is very limited supply, and it is strictly dictated by demand and supply. So we consider owning physical gold as pure speculation. In fact, within our portfolios that we provide for your bank, we encourage mining companies like Rio Tinto and BHP Billiton that not only has gold reserves, but they actually have physical cash flow that they pay dividends to their shareholders. So we kind of go into mining companies. Therefore, gold in this environment was only chased up because of expectation of inflation, which we don't have today.
Well, speaking of inflation, our next question from Mr. Chen is, will there be dramatic inflation in 2021? Aren't we due for some big explosion in inflation?
You know, in normal history, economic history would dictate that when you have so much stimulus in the economy, that you would see signs of inflation. So you may or may not have read a lot about the modern uh, theory on money, and that is that you keep spending because the governments, as long as they are in charge of their currency, can keep printing money. Uh, Looking at the fiscal and the monetary stimulus that we've had, and looking at how low the interest rates are, and the federal government or the Federal Reserve providing stimulus in terms of buying bonds, buying mortgages, buying ETFs now, it's not really created a significant ramp up in inflation. We do not believe that until the unemployment situation is going to be significantly lower than today, that we are going to see much in terms of inflation. The global economy is in recession. The global economy in 2020 is expected to decline almost 4 to 5%. So really, you don't have a lot of demand for products. And so it's unlikely that significant price increases could be instigated. Now, that does not mean that you're not going to see some price increases in certain products. One classic case, for example, and I think this is very interesting, which our listeners will find, is when we had the pandemic, it was very difficult to find toilet paper, and you'd say, wow, why is toilet paper in such a big demand, right? So everybody's trying to stock up on toilet paper if the grocery store's closed or whatever. But when you look at the inventory of the paper companies, they had no problems. So what was the problem? The problem was not in the manufacturing of paper products, but it was a supply chain. So when a paper company makes toilet paper, they have a distribution channel for retail outlets like your Costco's and your grocery stores. Then they have a supply chain for the commercial side, where there are businesses and corporate offices which are getting those supplies. So when the supply or the demand in the corporate offices decline with the work from home environment, that supply chain could not adjust right away to provide the supply in the retail side. And therefore there was a significant impact and decline in paper products. Now, everybody has to do their business, whether you do it at the work or at work at home. So when the work at home business was passed on, the demand for paper products rose. So it's just common sense. And, eventually it kind of just settles down. But we are not seeing any significant pressures on inflation as we speak today.
Thank you. So here's a question, because you did show interesting the chart where all three branches of government. So here's the question: if the two Senate seats in Georgia flip to Democrat, and then all three branches are with Democrat control, do you think that would your projections change the way you see things now? Do you see it being solidly different if all three?
Yes, it would absolutely make a big difference because right now the markets are expecting a gridlock situation. So that would certainly be a negative for the markets. Having said that, though, it would be inconceivable that when the economy is in a recession and unemployment is running, 11 million people, that the federal government is likely to push through tax situation as it initially proposed. Another important thing to point out is that within the Senate, they were some of the people who went to the Republican side may not from a Republican to a Democrat side. They come from states that are not very liberal states, if you will. So the chances of them voting, even though it's controlled by the Democrats, is unlikely to pass in the same form as is initially proposed. So yes, it is likely to have an impact, and no, it is unlikely to have the same level of impact because the new members in the Senate are unlikely to go with the same package that was initially proposed.
So which sectors are poised to benefit from the Biden administration and which would be hurt?
Yes, so clearly fossil fuel is unlikely to benefit from the Biden administration, despite the rhetoric that, Pennsylvania is going to allow to be continue with fracking. Eventually, their policies are more towards green energy. And so solar energy and environmentally friendly companies are likely to benefit more. I think that the Obamacare will continue. A divided Congress will help the pharmaceutical companies as well. Uh, and also, infrastructure companies will also benefit quite significantly. And the idea there is that you are going to spend money to build infrastructure. And the beauty of the infrastructure, by the way, is that there is a whole chain of companies that could benefit. So clearly, the mid-size and the small cap companies will also benefit because they will provide either the aggregates or the cement or the labor or the technical know-how at the lower level. So clearly, mid and small companies will benefit if we had a ramp up in infrastructure as well.
So the next question coming from Antonio is near and dear to my heart. Of course, as bankers, especially community bankers, we really do not like Bitcoin, the cryptocurrency. It disrupts our industry, especially for us small players. Payment system is what we have still, and with the cryptocurrency, of course, also from a regulatory standpoint, as our clients know, that if you come in and get $6,000, we have to know what you need cash for, and if you're depositing, we have to know where you got the cash. If you get a wire for $400,000 and you say you sold something, we've got to get a bill of sale. So we are required by the government to do all of this documentation on these transactions. So with Bitcoin, I philosophically don't like it, and I see an opportunity for a lot of crime, but it's obviously here to stay. I guess there's a couple of thousand cryptocurrencies now. So how do you see cryptocurrency as an investment?
I have to admit, I'm not an expert in that area, so I can't give you all the details. But following through major banks and looking at the readings of the Federal Reserve, while crypto is not mainstream yet, Bitcoin is certainly taking on more of a mainstream attractiveness, if you will. Having said that, we think it's still in its infancy. But with any technology, I think there are still, because it's its infancy, there is a significant potential for crime, especially for money laundering, etc. So bigger banks, at least in this point, are unlikely to encourage any of those, and neither is the Federal Reserve, because Federal Reserve is going to worry more about terrorism and money laundering as well. So Bitcoin probably a little bit more advanced than crypto, but I don't think that is as secure as the monetary system would like it to be.
This might be a little bit out of your wheelhouse as well. So the question is it safe to assume that the real estate will still be a leader in 2021 and coming periods? I guess it's someone heavily involved in real estate and wants to make sure.
Real estate, we do have exposure to real estate within our asset allocation, but we look at real estate in finer grades. So we look at obviously residential, we look at commercial real estate, and even within commercial real estate, you have uh, retail malls related REITs. You have REITs focused on medical properties and doctors. And then you have industrial REITs. And then finally, you have telco REITs, people who have towers that they are, that they're renting out to telco companies. So each one has a different level of attractiveness. In the least attractive is the retail space because the mall environment has totally changed. Many of the main mall anchors have declared bankruptcy, as you know. JCPenney, J. Crew, Macy's, and is also into trouble. So obviously, that is not an attractive proposition right now, and the chances are that they would go more under restructuring to reduce their long-term debt rather than do anything else at that point. On the other hand, we are seeing that REITs that are focused on commercial are also seeing a lot of problems. They are seeing late payments on their rents. And if the work from home environment picks up a lot of steam, which we are seeing that some markets which are very heavy on the commercial side, like California and New York City, we see that there is going to be likely more trouble in that area. Turning to residential commercial real estate, again, New York City is going to be in trouble. San Francisco, we are also seeing a decline in real estate prices. But that doesn't mean that, you guys are in the right zip code, if you will, in Florida, where, everybody wants to move to nice weather and no taxes. So yes, I think you should continue to see an attractive flow of people. So it depends on which zip code you are, which state you are. And lastly, we do see that the yield that is being thrown out by companies like American Tower and SBAC that have the towers, and with the 5G, there's going to be more demand for the infrastructure. So they are likely to see much less negative impact to their business than, let's say, the commercial real estate market.
Thank you. So yeah, one of our attendees was asking specifically, and of course, there's been this anticipated bubble for the last 5 or 6 years, banks trying to be more prudent when it comes to commercial real estate financing. And the bubble, an anticipation with rates low and inventories low and everyone buying. But like you said, we are very fortunate in South Florida to have a zip code that's highly desirable for the aforementioned reasons between the weather and our tax situation for now.
Right.
One of the slides that really sent shivers down my spine, slide 45 on the tax plan. I mean, those were some major adjustments to our taxes. How long, of course, not being a prognosticator, but what's typical to expect those kind of dramatic changes in the tax plan? Are these things that can be an executive order, take short order? Is it something that he wants to do, but it could take 2, 3, 4 years to do? Or do you see that happening in 2021? Because obviously, if these kinds of taxes are adjusted so greatly in 2021, then that would also have a big impact on what your investment portfolio would look like right now, or even moving your traditional IRA to a Roth IRA to take those gains. What are your thoughts?
Yeah, I think, how soon they can enact it is really anybody's guess at this point, because we are still waiting for the runoff in Georgia. So we really don't know if the Senate is going to still remain with the Republicans. If it is, I don't think there's any chance that these types of tax increases are going to materialize. And let's say that it does get, it is controlled by the Democrats. Even in that situation, as I mentioned, the states from where the Democrats have gained seats to control the Senate are unlikely to go for a massive rehaul of the tax policy. So most likely scenario is it's either going to be a gridlock where nothing happens, or it's going to be a muted policy on the tax front. Uh, you know, at the end of the day, tax and spend is not always good because, as I shared with you before, that we are or we were one of the most highly taxed on the corporate side countries amongst the developed world. And when the Trump administration got rid of the increased tax on the corporation, it actually allowed for companies to come in the US. It also allowed foreign companies to build plants in the US. It got employment back into the US. And so I don't believe that increasing taxes on corporation is the way to do it. And as I shared with you before, corporate taxes only accounts for roughly 7% of the tax revenue that we get in the US. So if you're already increasing the income taxes on the payroll as well as on individuals, leave the corporate tax alone, leave the dividend tax alone, leave the capital gain tax alone. You are stifling capitalism, which really has been the engine for creating growth. Now, one thing that I will certainly emphasize is that, it has to be remembered that large companies pay very little tax relative to the federal revenues on the taxes. And number two, large companies are not the biggest creators of employment in the US. So when you have the small business having the disproportional negative impact of taxes, there is a cost. And the cost is unemployment will spike up. Investment in US will remain low, and that will have structurally long-term negative impacts to the US economy. So, it sounds good that I'm going to raise taxes, it's going to create a balanced budget, but what are the long-term impacts to the competitiveness of the US corporations? What are the long-term impacts of creating productive employment, not just one-time infrastructure jobs? And those are not good signs. And so we remain hopeful as an organization that the tax policy would be more in sync with the current environment in which we reside.
One of the slides that also I found fascinating was the stimulus on slide 38, that the dollars that the U.S. has been putting in stimulus, really the only one comparable to us is Australia, and perhaps Canada is about the same level. So you see how much more money through loan guarantees has gone in Germany and Italy and Japan, and their economies are suffering. So as much money, but just in a different vehicle. So I found that really quite fascinating.
Yes, and that's why, I think that, unfortunately, the US policy on stimulus and the effectiveness has not received the level of credit that it really should. Politics aside, I think US was the first country to provide the level of stimulus fast and immediate. Yes, there were some people who benefited. Yes, it always happens in a blanket help. And the key there is to help the ones who need it the most. And that doesn't mean that somebody who doesn't need gets a benefit. But the key is you don't want somebody who needs it not to get the benefit. So I think the US did a fantastic job, in my opinion. They put the money where the mouth is, which allows the flow of the money in the economy. And therefore, the US is fiscally in a much, much better position than the Europeans. I think the Europeans did not do it right. Canada and Australia, by the way, they did it right, and you can see that in the economy. And you can see even China did it this right way, where they put the money into the hands of the consumer. India, unfortunately, is suffering. Their GDP growth is horrible. And unfortunately, they just don't have the capital to do those kind of revenue expenditures without having their credit quality cut back. So, it's not just sometimes about right versus wrong, it's what you really can do as an account.
Another interesting concept that you put forward was on slide 23 for me. The decline in equities and the increase in bonds, are these in absolute dollars or percentages?
No, these are actual dollars. So you can see it's the cumulative fund flows in millions of dollars and millions of dollars also on the other hand. So it's the same scale, but you can see that one is on the left-hand side because the flows in money market funds has been much less, because obviously money market funds are yielding very little. So we didn't want the line to get lost. So the green line corresponds to the scale on the right, which is the right-hand scale, but the scale on the left, which is for the equity market flows and the fixed income flows, is a much, much bigger number. And there are some changes demographically that is driving the flows in fixed income. And one thing that keeps me up at night, Veronica, is simply that, as the US population is aging and there's a lot of target date funds. So what does a target date fund do? As the maturity increases or gets shortened for a person retiring, they are shifting more money into fixed income, right? So when the fixed income allocation increases, the demand for fixed income instrument increases. So these guys are buying bonds even though the price of the bonds is so rich. Now take a situation 10 years down the road, they have to go in and sell it, okay? When those bonds have to be sold, who is going to buy it? And what is the demand supply imbalance going to mean for the price of the bonds? Nobody really knows. And I've talked to the BlackRock guys and said, hey, have you stress tested this? And I get an answer, but it's nowhere near to a quantifiable answer. And so it is a risk. I can't tell you honestly what the quantifiable risk is, but you just imagine, look at that line of the fixed income investment. And then you say, who is going to be the buyer of those bonds? Because when you and I are going to retire and we need the money and the bonds are going to be sold, your guess is as good as mine.
That's where the mattress comes in handy. Or better yet, your money is safe at First National. We'll take it. Well, this has been great, and I so much appreciate you. You are brilliant in what you do, and you're able to deliver it to us in an easy to digest and understand manner. So Amit, I do thank you so much for taking this better than an hour and a half with us this afternoon. For those of you who have asked, the video will be available on fnbsm.com and also on our YouTube channel, which we have in case you haven't checked that out. And Amit has worked very hard with his research team on preparing these slides. They're of great value. So we will have them available to our private clients. And you would just have to contact your private banker, and you might get to see some of them. But nevertheless, the entire show today is available online. And of course, that will include not only the slides, but the wisdom that goes with each one. Amit, again, I thank you so much. I bid you a good evening. And everyone, thank you so much. This is Veronica Flores signing off from WFNBSM. Thanks for joining us tonight. Have a good evening. And stay safe and wear your mask. Mine's right here, but I'm alone in my office, so I didn't need it. Good night, everyone.